Office real estate has been an unloved part of the real estate sector, but a return to office mandates starting to change that outlook. Joining me now to discuss, Colin Lynch, Head of Alternative Investments with TD Asset Management. Colin, great to have you back on the program.
It's always great to be here. Thanks for having me.
So here are the two of us in an office. We know that many of our co-workers will be joining us on a more regular basis in the coming weeks. This return to office trend is spurring some optimism now?
We are certainly seeing it. So if you go back, we had the departure from the office for a health emergency. And then we had a bit of a phased return. But that phased return was especially phased here in Canada, in the United States, part of the United Kingdom, and parts of Australia. In other parts of the world, Japan, Singapore, France, Germany, not as phased. People have been in the office. And then within Canada, the cities with huge commutes had the slowest return. But now that is changing. And we are seeing in the office market in cities like Toronto, some would say, some brokers would say, record leasing. And why? Because we have a growing number of return to office announcements pronouncing either 4 days a week, 5 days a week. And the reality is those occupiers have to plan for the space. And so we're seeing them now in the market signing deals for space. And not just in the highest quality office, but certainly in the highest quality office, but increasingly in some of those B-class office buildings that were very much unloved. That being said, the vacancy rates are beginning to fall. When you look at things like sublets, which is I'm a tenant, I lease space, I don't need as much space, so I put some of that space on the market, that is really beginning to shrink. And the incentives that landlords are giving out are also beginning to shrink. And so yes, for the first time in quite some time, we have real optimism for the office market.
Is that optimism strong enough not only to start filling that space that had been vacant, but actually get, and I know it's early days, to start getting people thinking about, do we need to build more in the big cities?
So I would say there are people beginning to think about building more. Generally, it's premature. In certain cities, like Calgary, we are still having conversations about taking space out of the market, those office conversions programs. And I would say those conversion programs are still needed. In some cities, like a Calgary, like in the States, in Oakland, for instance, there is a permanent surplus, I would say permanent surplus of office space. And so therefore, the reduction in office space and conversion to other uses is appropriate writ large. It's not, you need financial help to do so, but from a market perspective, it's appropriate. In other cities, like Toronto, I know there is a conversation about bringing some office developments that were initially proposed years ago back to the fore. Even if those kick off, it will take years to move through the process, attract a lead tenant, construct. Like we were talking 2029, 2030. So that's 5 years. But I would say even with that lag, it's probably a little early to go down the office construction route.
I'm going to talk more optimistic futurism kind of here, but when you talked about the killer commutes, right? And
Yes.
that's where we've seen the lower uptake, where if it's going to take you an hour or even more to get in on a train or get in on a bus, you're not so happy about coming back in the office. Is there any thinking in the industry that perhaps going forward, all the office towers don't need to be concentrated in one little area? For example, around Bay Street down here, and you got to come in all the way from, for example, Brampton.
It's a great point. Because if you go back a few years, the conversation actually was around satellites. So if you go back to the 80s here in Toronto, you had different city centers. Downtown Toronto, you had North York City Centre, you had Scarborough City Centre, Etobicoke, et cetera, Mississauga City Centre. The thought was that you'd have all of these different office nodes and people would commute to those office nodes. What's really happened, however, is the reverse. We've seen the growth of downtown, and new construction in those former office nodes is primarily residential. We are doubling down on that today. So increasingly, to your point, office occupiers want to be around that central transit node. So in Toronto, yes, Union Station. Why? Because you have the GO network that all the lines all a line at Union Station, you have a subway as well. And so from an ease of commute, that's easiest. Now, that also happens to relate to new construction. So the newest construction, most significant construction, has been really around walking distance to Union Station for that reason. And you see that in other cities, like New York City. You have significant new construction around Grand Central Station for that same reason. If you have a long commute and you've already taken a GO train, for instance, do you really want to take a subway and a bus and then walk in addition to that? So that's really what's motivated the desire for tenants to be located in close, ideally walking proximity of major transit nodes. We've seen this, whether it's throughout the 2000s, 2010s, COVID has doubled down on the importance of that.
Interesting stuff. I want to pick your brain about other things that are happening too, maybe part of your other mandate when we talk about alternative investments. Private credit. There has been some concerns in recent weeks. The market seems to be looking past them in the last little while, shooting to new highs. How are you viewing the situation?
Yeah, certainly the market has been quite interesting. And I know that there's a comment out there about cockroaches as well. So let's take the highs and the cockroaches together, in the sense that there is significant pools of capital out there looking for a home. And that home, whether it's in the equity markets or whether it's in the private credit markets. In the private credit markets, you see that in something called spreads, right? What is the premium that you are going to get as an investor, a premium that you're going to pay as a borrower for accessing and tapping the private credit market? The market's grown dramatically because this space used to be the domain of banks and they've broadly pulled away. And then you have other types of lenders that have stepped in. And those other types of lenders have capital and they're looking to put it to work, and so you see compression in spreads. Now, let's look at cockroaches. Unfortunately, cockroaches exist. They're everywhere. The key is, are they in your house?
Yeah.
Similar to your portfolio, the key is, are they in your portfolio? And to understand that, you need to know the quality of underwriting done. And when I say underwriting, what that means is basically due diligence. And there are spaces in the lending world that are more prone to cockroaches than other spaces. And so if you operate in those spaces, you have to do your DD, do your due diligence. And so the risk is that as new players enter the space, their standards aren't as robust, they make mistakes, they attract cockroaches. And the risk for the industry is the industry has a bad name because of that. Not all participants are the same, not all loans are the same, not all risk is the same, not all sectors are the same. And so in this time of heady interest in the private credit space, and it's justified because you can get a very attractive premium and that credit plays a diversifying role in your portfolio, it is extremely important, like it always is, to make sure that you have the due diligence done right.